free option trading course for beginners. Yes, it's a couple hours, but this is going to be totally worth it because I noticed that nothing on YouTube right now goes in detail enough and explains things simply with examples, with managing, closing, and opening positions profitably. I want to make sure that this course right here teaches you everything, even if you're a complete beginner, to helping you understand how to make money option trading. Here is the full list of timestamps for everything I'll be covering in this course, as well as you can find them on the YouTube play bar. I can easily charge, and I have charged thousands of dollars for this type of education, and now I'm giving it away for free. And this full course is especially designed to take you from a complete beginner, even if you don't have anything about option trading, even if you don't know what an option is, to a confident option trader equipped with the knowledge to create a safe, consistent, and pretty much completely passive income online. This way you can retire early with options. That's exactly what I've achieved after many, many years. Yes, it does take years to actually scale up a portfolio to 7 figures. I'm not going to sell you a fake dream and tell you that this happens overnight or this happens in 1 week. This definitely takes time, but is worthwhile because this is something that you can do on the side. It only takes about 1 hour per week to actually scale a passive, safe, consistent income. I have 10 years of experience. I started at 19 years old with just $2,000. Now my portfolios sit at $2 million, another $2 million, and I have another portfolio that I'm scaling with a small amount of money. I went from pretty much $2,000 in my bank account to having a multi-million-dollar portfolio, allowing me to retire before the age of 30 and travel around full time. And I don't say this to brag. I'm saying this to show you that anybody can do this. So with that being said, let's jump into it and learn how to actually trade options. So first of all, what is an option and how is it different from a stock? Well, we all know what a stock is, right? When you buy a share of a stock, you're just buying a really, really small percentage of a company, and you ideally want that company to rise in value. So say you buy a share of stock of Apple, when the company, raises its value, so does that one share of stock that you bought. So if you bought a stock for $100, you're hoping that it goes up to 101, 105, 110. That's what you want to happen with a stock. Now, let's say that you want to buy one Apple option contract. Yep, that's right. You have to buy an option in the form of a contract instead of a share. Okay, so an option is very similar. Instead of buying the shares, you're buying an option. And that option just gives you access to those shares. So when you buy an option, you are betting on the stock also going up. It's a little bit different, okay? Say you only pay $100 for an option. That option can raise a lot in value. It can go up from 100 to 200 to 300. You can many times your money versus a stock. It's a very small amount of money, the same amount of money, but it does not rise and fall the same as an option does. See, an option is almost like a leverage tool, okay? Imagine I have a lever here, okay? If I push the lever a little bit, this option value goes up a lot. It also does go down a lot if the lever is not going up. Whereas a stock, there really isn't a lever. It just goes up and down. So here's how it works. Let's say a stock is trading at $50 per share and you really like that stock. You think it's going to go up a lot in the next 30 days. In fact, you like it so much that you want to buy 100 shares of it. But that would be pretty expensive, right? That will cost you $5,000. Now, I see you looking at this stock and I already own 100 shares of it. I like this stock too, but I don't think it's going to go up past a certain amount in the next 30 days. So I say, hey, I'll make a deal. I think the stock will stay below 55 in the next 30 days. So if it goes to $55 or higher at any point in the next 30 days, I'll give you the option to buy my 100 shares at $55 per share. Even if it goes to 60 per share, you can still buy it for 55. And if you decide to exercise that option, the broker will buy it at $55 per share for you, then immediately sell that at the market price, and you get to keep the difference. So you don't have to spend any money, and you still get the same benefit as if you had bought 100 shares of the actual stock. But if you want that option, you have to pay me $200. So if the stock goes up to $60, you have the option to buy it at $55 using the broker's money and immediately sell it at $60 for a profit of $5 per share. And since I have 100 shares, you will make $500. But since you paid me $200 for that option, you actually make $300, which is still pretty good. Now, if you're wrong and the stock goes down, stays flat, or doesn't go above 55, you don't lose any money because you never owned the stock in the first place. But you do lose the $200 that you paid me for the option. That's essentially how an option contract works.
That specifically was how a call option works. And there are also put options where you're betting on the stock going down, but we'll get into that in more detail later. Now, let's go back to the same scenario, but this time I'm going to teach you the option terminology that we use. Strike price. So in that scenario, 55 was what we call the strike price. The strike price is a price that the buyer and the seller agree on, at which the buyer has the option to buy or sell shares of a stock. If the stock goes past the strike price, we call it in the money. Otherwise, it is considered out of the money. Expiration date. The expiration date is the date at which the buyer no longer has their option. So in that scenario, I kept mentioning 30 days. That means you had 30 days for the stock to hopefully go above $55. But the expiration date can be as short as 1 day or even 0 days or even as long as multiple years. So there's a whole lot of differences in the expiration date. We'll be talking about later the best expiration date to pick. Exercising an assignment. When the buyer exercises their option, that means they're going through with the deal. On the other side, the seller will get assigned if the buyer exercises their option.
So let's talk about the buyer and the seller, okay? For every option, there is a buyer, someone who's buying that option, and a seller who is selling that option. The buyer and the seller are basically betting against each other. So only one person can win. That's why they call this a zero-sum game. That's why option trading can be hard if you don't know what you're doing. There are a lot of sharks out there trying to make money. But the good news is Uncle Henry here has been doing this for a very long time. So if you stick through this video, I'm going to show you how to actually be a winner in this overall game. When different things happen to the stock, like it goes up or it goes down, or if it even stays completely stable, this will depend on the movement of the option. Depending on what type of option contract that you have, there's only two. There's a call option and a put option. Okay? Depending on this movement, both people can make money or both people can actually lose money depending on the option that they are buying. There are calls and puts, which is very simple, but you can also combine calls and puts together. And we're going to talk about that in a little bit. So don't get confused just yet. We're going to keep it very simple and we're going to build up and scale as this video goes along. And we're actually going to cover even the more advanced stuff later on in this video. We're going to talk about spreads. We're going to talk about buying strategies like bull call spreads, iron condors. We're going to be talking about a lot of good stuff, as well as technical analysis, as well as managing your position properly, cutting your losses, making more profits. We're going to get all into that in just a moment. So this is a much more different from your standard stock trading strategy. An option trading strategy or the option market is a little bit different only in the sense that options move differently. But the market is very similar. It's still the same stocks. It's still the same movements up and down on the stock. Just the option behaves differently. If you have a lot of questions, don't worry. That's completely normal. I'm going to answer all the questions you might have by going into my Robinhood portfolio. This is a trading platform, by the way. You're welcome to use any trading platform that you want. I'm just a coach showing you. And if you do want to learn from me personally, there is a link in the description for my personal Discord community. So now that I have Robinhood open, I'm going to search up Apple and click Trade Apple Options. Okay, so I'm going to go to the top here. I'm going to type in AAPL. So AAPL. Once I click into that, you can see I do have 7,000 shares right now. I'm going to go into trade right here on the bottom right in trade options. So right here, you will see right away, there is something called an option chain essentially. There's different expiration days, and this does look different if you're using a different broker. So I can go to May 17. I can go to May 31. Okay. And regardless of what expiration I go to, it still says buy, sell, call, put. Okay. So essentially, it's always going to be saying buy or sell, a call or a put. So there's only 4 things you can actually do. Now, don't get intimidated by this screen. I know it looks very complicated to beginners. Only pay attention to the numbers I'm explaining, because if you try to take everything all in at once, you might get confused. So as you can see at the top, you can either buy or sell an option. You can buy or sell a call or put option. So let's talk about buying a call option on Apple. If I go to buy, call, now I get to select the strike price, okay? So I can pick a different expiration day. So whether I go for, let's just say we're going to go out into the future, and we're going to go for October 18, okay? So if I click October 18 right here, that is the expiration day. This option will be good until October 18, okay? That's when this option officially expires, and that's it. That's when you actually have your profit or loss if you hold the option to expiration. Now, this may sound a little bit confusing, but although options expire at a certain date, you're actually able to trade them before or after that expiration date. So let's say that I go ahead and I buy a call option. Let's go to 190. Okay, you can see here if I click into this, it will give me the option to buy Apple 190 call for 10/17 expiration. So the price that I picked here, the 190, is called the strike price. That's basically where I want Apple to go to. So if Apple goes to 190, that means I'm going to break even. All right. If it goes above 190, that's where I can make money. The expiration is 1017. That's when this option expires, and that's it. Sayonara. Hopefully, I go above 190 by the 1017 expiration, or ideally, I'm way above the 190 call strike price. So you'll notice a few other things on the screen right now. So you can see that there is a bid, there's an ask, okay? If you're buying an option, you will have to buy closer to the ask. If you are selling an option, you will have to sell it closer to the bid. Now, we're just talking about buying an option right now. So if I go to one contract, I go into this limit price and I click 9. I'm picking 9 because typically when you see there's a bid and an ask, you're typically going to get the middle price. So right here it's 890, 910. You're going to get filled right in the middle for $9 in most cases. You can see here there is a max cost. In my program and in my Discord community, I'm teaching people how to mainly sell options for income. But for this example, right here, this is a buying strategy. Now, I don't love buying strategies because buying strategies are very high reward, but also a lot higher on the risk versus selling strategies. We'll talk more about that later in this video. But in this example, this will cost you $900.03. There's a little 3-cent fee, regulation fee from Robinhood now that they just recently implemented. So if I go to review this order, you will now see that I can easily just swipe up and submit this order. And this order would buy me one call option for 190 strike expiring in October 17, 2024. If you're watching this video in the future, by the way, this is the same logic, the same thought process that you can apply over and over again. Option trading doesn't change. In fact, I've been using the same option strategies for the past 10 years and I've been very profitable. Now, I want to go back here and talk a little bit more about mindset and how to manage a strategy just like this. So if you go into the middle here, you'll see that I have an expiration day that is October 18. All right, now this is an option that expires many days into the future. You can also trade options that are 30 days from expiration. Heck, 1 week from expiration, 1 day from expiration. You can even trade options that are expiring on the same exact day. That means that I have an option to buy Apple here that's going to be expiring in many months. However, I can also go to a different expiration day. For example, I can go for May 10. As I'm making this video, that would be a very short expiration day. You'll actually even notice here that if I click the 182.5 call option here, it's going to be trading for a lot cheaper. It's only trading for $2.70 per contract. See, the thing is about options, the farther out you go, the more expensive they get. The reason why they're more expensive is a lot more stuff can happen from now until that long expiration date. But if you buy options that are very short term, they're going to be a lot cheaper. And that's because the market knows and they're pricing in a proper premium to account for the risk that a buyer or a seller is taking. Now, to have any option, to buy any call option, first, I need to pay for it. And this is what the number in the green right here looks like. So it's either 270. If I go out farther out of the money, it's going to be cheaper. It's going to be 148 or 71 cents even. So the farther out of the money you go, the cheaper the premium becomes. You can see that the price is different for every single option. The price of the premium is calculated based on multiple different factors. One of them is the strike price. The further in the money the strike price is, the more expensive the premium is. So if this option's in the money, basically, since you see the Apple's at 181, if I were to buy a call option that's at 180, it's going to be more expensive. If I buy something that's 175, it's even more expensive because right here it already has intrinsic value. See, options are really priced based on two different things, okay? There's intrinsic value, there's extrinsic value. Intrinsic is how much are we already in the money, all right? So here at 175, call option, it's already in the money by $7. It's already in there. Apple's already above 175. That's the intrinsic value. Now, the extrinsic value would be this. If I go up to 190, 34 cents right here is pretty cheap, but why does it cost anything? Well, there's no intrinsic value at all. Apple's not at 190. It's not really even that close to 190. But the reason why this has value is because there's a few other factors at play, okay? One of the factors is there is a chance that it'll go into the money. There is a chance that Apple will go up. And specifically, as you see on the screen right here, the delta is 0.12. That means there's a 12% chance that this option will go into the money. Isn't that really cool? There's a 12% chance. You know exactly, based on the delta, what the chances are of the option expiring in the money at expiration. So by this expiration of 5/10, okay, May 10th, there is a 12% chance that Apple will be at 190. Not that much. However, it's something. That's why this option is so cheap, because there's actually a small chance that it'll go into the money. Now, this is one of the extrinsic values, okay? There's also some other extrinsic values like volatility, okay? If volatility increases, this option will also increase. So what's really interesting is you can wake up one morning and realize that your options are worth a lot more money, and that's because option volatility actually favors the option buyer. So when the market's more volatile, options become better because you don't want to take the risk of buying shares. You get a much better price just buying a small amount of an option. And if the market is crazy, this option can make a lot of money. And that's why these options become more valuable with higher implied volatility in the market. To help you remember, you can just think of in the money as all the strike prices that would be favorable to you, where you've already made money if it were to be at expiration. So if a stock goes up a lot, let's say you have Meta, it goes way past, your strike price, let's say 500, and your strike price is 450, perfect. That means you made a lot of money if you have bought a call option. Now, on the flip side, the further out of the money, the cheaper the premium is going to become, because I'm only getting the option to buy the stock at a more expensive price than I could get it at the market today. So if I'm going to be paying for an option, I really don't want to pay that much, because I'm essentially taking a bet. Hey, this stock will go up a lot, I think, and I'm willing to pay X amount of dollars for it to potentially go up. And if it goes past my strike price becoming in the money, then I'm going to be profitable. But if it doesn't, I lose whatever I put in for this option. So you can lose 100% of what you pay for an option. So for that to even be worth it, I would need the stock to go up and be out of the money from, being out of the money to becoming in the money. And that means the stock may have to move 10 or 20%. It just depends on your strike price. But typically, if a stock goes up by 5%, an option can go up 10, 15, or 20, even 25% easily. And that's because with options, you're putting up a very small amount of money. You do need the stock to go up a lot in the case of a call option. But if it does go up a lot, you start multiplying your money from, let's say, let's go over another example, actually, because I want to show you what this would look like. All right, so I'm going to pick an option, let's say May 17, and I'm going to buy an option right here at 185, okay? So you can see here that it says break even. The break even is 187.16. Now, the reason why you have this break even is you take the strike price of 185, and then you add $2.18 to get 187.18. Robinhood is kind of mispricing this by 2 cents here. But at that point, that's where you break even. Now, if it goes up, for example, to 190, you have a total gain of 190, okay, minus the 185 strike price, which is $5. Right? You paid 218, you have a profit of 5. You doubled your money. Okay? Apple went from 182 to 190. It only moved up $8, but you, however, have doubled your money. All right. If Apple went up to $200, all right, you would have a total profit of $15. You have put in 2. So you went from $2 to $15. You have multiplied your money over 7 times. Whereas a stock investor, if the stock goes from 182 to 200, he has made 10%, whereas you have made 700%. So you can see how valuable an option can be. Also, you do have to realize that if the stock goes to 184, the stock investor would make $2. However, in this example, you would actually lose $2 because Apple did not go into the money in this example. You would be below the 185 strike price that you have purchased. Therefore, you wouldn't make any money. Remember, more out of the money means that it's riskier for you to buy that option. Therefore, the premium is cheaper. More in the money means it's riskier for the seller of the option and safer for you as the buyer. So the premium, aka what you pay up front for an option, is going to be more expensive. The second metric that determines the price of an option premium is the expiration date. So right now you have seen that I had an October expiration. Let's just say that we had an expiration of 30 days. Following the same principles of riskier options being cheaper premiums and safer options being more expensive premiums, it's going to be way more likely that an option that is going to be more cheaper is going to expire a lot sooner, and an option that's going to expire a lot later is going to be a lot more expensive. It's also going to be way more likely that an option is going to become more favorable for you the longer the option is to the expiration date. That's because there is more that can happen. So the market perfectly has these options priced in, and oftentimes a lot of people do say that it's hard to trade options because a lot is priced in. In fact, one of my students asked me, should I close a position and open up this one or this one? They gave me a couple different options, and I usually tell them that both of these options are actually very, very similar. Like if we go back to the example of Apple being at $200 in market price and me picking a strike price of 185, aka having an option that, I want to buy the shares at 185. If I pick a really long expiration date, like 2 years, it's way more likely that Apple is going to be at $200 or $250 in 2 years. At the same point, during the next 2 days, it's probably not going to move anywhere. So that's why the option premium is going to be a lot more expensive the longer there is until expiration. The third thing that determines option premium is how volatile a stock is. Now, I've talked about implied volatility. So basically, if it tends to go up and down by very large amounts quickly compared to, say other stocks that don't go up that much at all, that stock is going to be deemed more volatile by the market, okay? Like take Tesla, for example. Tesla is a pretty volatile stock because the price goes up and down a lot. So the premium for Tesla is going to be more expensive than a stock which is very stable, say Kraft Heinz. They're selling some ketchup and the company is very stable. It's not moving up and down and it's not as volatile as Tesla, which is innovating. It has a lot of deliveries one quarter, and the next quarter, Elon Musk says something crazy and the whole market reacts and the stock is moving up and down a lot. So that implied volatility is just going to be a lot higher. That means the options are also going to be priced higher. Now that's partially a good thing because if you're selling options, you get more premium. If you're buying options, well, Tesla moves up and down a lot, so you could make a lot of money. So it is fairly priced, and the market is pricing in this extra movement to compensate for both the buyer and the seller. So it makes sense for both. Because if we go back to an example like Apple being at, let's say 200, if Apple was extremely volatile and it went up and down by 10, 20, $50 a day, trust me, this option would not be worth a couple of dollars. It would be worth tens, if not $20, because people would be scared. Who in their right mind would sell an option on Apple, right around where it's trading at right now? If the stock was moving from 200 down to 100, down to 50, if it was going like this, trust me, that premium would be very high. It would have to really compensate an investor for wanting to sell that option. Because again, this is a game of both buyers and sellers. So they both want to be correct and they both want to be compensated fairly for buying and selling. Just like everyone in the world wants to be compensated fairly, so does the option market. Now, here's where options get really crazy, really powerful, and potentially really dangerous, but only if you don't know what you're doing. Remember at the beginning of the video when I said that stock comes in the form of shares, but options come in the form of contracts? Well, one contract actually does not equal one share. One option contract actually controls 100 shares of whatever stock that you choose. But this is different from just regularly buying 100 shares of Apple stock, because if I want to buy 100 shares of Apple stock, that's going to be $17,000. But if I buy an option contract, as you already saw, it's a couple $100. You're putting up a very small amount of money to get a very huge benefit. And if I up this to 2 contracts, now I'm going to be able to share or control 200 shares, 3 contracts to 300 shares, and so on. But let me bring it back down to one contract for now. So if we compare the hefty price of $17,000 up front for the stock versus a total premium up front of the option contract, which is $200, what is better? What seems better to you? It seems crazy, right? What's the catch? How can this option cost $200 give you the same value? Well, that all depends on moneyness. Is it in the money or is it out of the money? And yes, I know, even from the looks of it, it can be really crazy risking $17,000 up front. Most beginners don't even have $17,000 to buy 100 shares. Even, if they could buy $17,000 worth, it might be really scary. But an option contract that costs $200 is a much easier way to get into the market and learn about trading and not have to have all that capital to really learn with. You can start scaling with just a couple $100. In fact, I have many videos on this channel about scaling a small portfolio and actually specialize in taking $7,000, to $10,000 accounts up to $20,000 and even $30,000 in 1 year. And that's in my Discord program. I call that my small account scaling challenge. So let's keep going. The regular stock, you're essentially risking $17,000. But for the option, the maximum amount of money that you can lose is the premium that you pay for that option. You can't lose more than the premium. If you pay $200, that $200 is gone. But the good news is you can't lose more than that $200. Either that option is going to make you a lot of money or that option is going to lose and you're going to lose your $200. Again, not more than $200 if you put $200 in. Because remember that you have the option to buy the stock at that strike price, okay? If you buy a $200 strike call option, you have the option to buy 100 shares. Now look, you don't have to actually buy the 100 shares. Again, if it goes to expiration, the stock is at 250, the call option means that you're buying 100 shares. However, right before expiration or any time before expiration, you can just sell that option. It's going to be a lot more valuable than buying 100 shares, especially if you don't have the money to do so. And now you might be wondering, well, what is the catch? What are the downsides of how this trade could play out? That's exactly what I'm going to show you right now. So let's go through some actual real life scenarios and I'll show you how they can play out. All right, so now we're going to go into my portfolio and we're going to look at a stock that is potentially attractive for buying a call option. Now I'm going to be a little bit more serious, and instead of just making an example, I'm actually going to show you something that I actually want to do when the market opens up and why I want to do it. First of all, you can see I do have many options here. and Apple is one of my favorite positions. So I'm going to go through my watch list. And by the way, you should have your own watch list. If you want to be a successful investor, you don't want to look at whatever is hype. You want to look at a specific stock list that you build of stocks that you really like and that you believe in. So for example, I actually want to take a look at Starbucks because recently, if I look at the 1 month chart, you can see that Starbucks went down 17% in the past month. They didn't do so well. Now, some people might say, oh, wow, the stock is going down. But look, nobody actually knows. What happened in the past is the past. What's going to happen in the future, nobody knows. Not Warren Buffett, not a billionaire, really nobody. But I'll tell you this, when a stock goes down by 17% in 1 month, that's actually a very good time to potentially use the option buying strategy.
Your future is at your fingertips. Take advantage of the flexibility and diversity of futures trading with NinjaTrader, the #1 rated futures broker. Start trading futures today.
It's glorious. For a limited time, get a free upgrade to Home Internet Plus. Just $50 a month.
Strategy of buying a call option, because let's say that this stock may have a shift in momentum. Okay, what that means is the stock is going down, 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 and instead of buying shares, which could be a little bit scary, some people call this a falling knife. Okay, it's a falling knife. The stock is going down. You don't want to catch it. You might feel that pain. You might say, oh, I bought it at 73, now it's at 63. It goes down $10 more. You might feel stupid. You might feel that this is really risky. And in many ways, it is. But a call option would be very different here. A call option, you put up just a couple $100, as we mentioned, and let's say that the stock reverses and it goes back from 73 back up to let's not get overly optimistic and say it's going to go back up to 88, but let's just say that in the not too far future it might go back up to maybe 83, 84, something like that. Heck, even 80, that's fine as well. So here's what you would do. You would go to trade options, and in fact, I'm actually very, very interested in purchasing an option like this. I think that it's a very good idea, especially right after a stock has a lot of disappointment. Because what happens is when a stock has a lot of disappointment and the whole market basically sells off that stock, a lot of people lose confidence. Well, that price is already really depressed. People went from enthusiasm and ecstasy and excitement down to really depression and not having any hope. That's actually a good time to buy a stock or a good time to buy an option, because that option is undervalued in many ways, okay? And in many cases, people are not so optimistic. And when they become more optimistic about the stock's price, will go up, and the option will also go up in value. So again, I'm going to look at an expiration. Now, this stock went down a lot really quickly. So what I want to do is I don't want to pick a short-term expiration. If I were to pick an expiration really short-term, I'm not giving myself enough time for the option to actually make money or the stock to recover. So what I'm going to do is I'm going to pick an expiration date that gives me some time. So let's go for July 19th. So as I'm making this video, that's going to give me about 2 months. All right, so again, I said that I think the stock can go back up to maybe $80. All right, maybe $80 per share. So what I would do is I would buy, call. As you can see here, I'm at buy, call. And I can have a few different options, okay? I can go for an in-the-money option, so I can go for 65, okay? You can see here the break-even would be $74. I can also go for 70. I can go for 75. I can go for 80, but 80 wouldn't make any sense, right? Because we just said that our base case scenario is that we think the stock will go back up to $80. So buying an $80 call doesn't make any sense, because if it just goes to 80, we can't make any money. It's not going past 80, therefore we're not going to make money since we're not going to be in the money at expiration. Now, a common question is, why don't you just keep going lower? Why don't you just buy something like the $40 call? Well, the truth is you actually can. You can buy a $40 call, and you can see here that the break even is actually pretty good. It's at 73, okay? Now, the thing is, you do have to put up more money. So you can see here that the premium here is $35, which would actually be $3,500, because each option is worth 100 shares. So you wouldn't really want to do that. You would want to pick kind of a sweet spot. So that sweet spot for me would be about 70 or 75. Let's use 75 as an example. So if I were to buy the $75 call here, which would probably be my number one choice, I would go for this. This would be a slightly out of the money option. So if I buy the $75 call and I spend $2.24 for it, that means that if the stock goes up to 80, here I'm going to have a $5 gain, okay?
I'm putting up $2.24. So I'm basically turning $2.24 into $5, doubling my money. So if I go into this right here, I just buy 10 contracts, I can put in $2,240. My maximum gain will actually be $5,000. I just said maximum gain. I meant we will make $5,000 if it goes to 80. Our actual maximum gain is going to be unlimited. You can see right here the maximum profit is unlimited because if Starbucks goes to 85, 90, 200, 1,000, you keep making money as long as the stock is going up. So you don't have a cap on how much money you can make. However, you do have to understand that there is no way that Starbucks will be $500 per share by next couple of months. There's absolutely no way. That is actually impossible because the stock, I'll show you how to actually think about this. If you look at Starbucks right now, you can see if I scroll down here that there's a different statistics and the market cap is 82 billion. There is no way that a stock can basically double its market cap if it's already a big company. So this company, Starbucks, can't go from 82 billion to 164 billion. That's just not going to happen. So you do have to be logical with how you're trading options. You have to understand where the stock can potentially go. And we will talk about that in this course when we go over the technical analysis section. So let's go over some scenarios so you understand exactly what can happen, different scenarios, and how they can play out. So again, we're going to go to the July 19 expiration. And if I click the 75 here, let's go over what can potentially happen, okay? So if the stock is, say, below 75, let's say that Starbucks actually goes down in value from the current $73.89 to 71, 69, 65, whatever. All of that is going to be meaning that you're going to lose the $2.24 that you put up. You're going to lose it. If Starbucks is below 75, you're done. You've lost the money, okay? That's the first scenario. If it's below the strike price, you will lose money. Now, if it hits 75, you actually still lose money because even at 75, you have paid $2.24. If it is at 76, you've made $1, but you've spent $2.24. So you still lost $1.24. If it goes to $77, then you have made $2, but you paid $2.24. So now you lost 24 cents. So you see, you need the stock to go to $77.24 to break even. And then you are making money from that point on. So if the stock goes to 80, you made $5, you paid $2.24. If it goes to $90, you have made $15, okay? And so on and so forth. You can use this basic math to understand how much money you make. So we just had gone over how to buy call options, but there's a whole another side of it, which is selling call options. So the option seller is the one who writes the contract in the first place for the option buyer to choose from. Okay, so the option buyer is choosing a strike price, and that seller is also picking a strike price and an expiration date and all that stuff too. You have to pick the strike price that you're comfortable with selling the shares of stock. So when you're buying a call option, you're saying, hey, I want to buy shares of this company at 200. Okay, but when you're selling a call option, you're saying I'm ready to sell shares at 200, your strike price, okay? So when you're selling call options, you can't just sell a call option. The reason why you can't just sell a call option is because you do need the shares. With the buying a call option, you don't need the shares. Just buy the call option. You're good. Now, when you're selling a call option, you do need 100 shares. This is a more amount of money that you have to invest. So covered calls are, I wouldn't say they're more advanced. They're very, very easy. However, you do need more capital to write or to sell a covered call. When I say write a covered call or sell, that's a synonym, okay? So writing and selling is the same thing. You're selling a call option. Now, if you were just to sell a call option to the market, you'd be at very high risk because remember, the call option buyer who buys the call option has unlimited upside. They can make as much money as they want. So if you were just to sell a call option, that'd be risky. You would be potentially giving yourself unlimited risk, which I would never recommend. I would not recommend you do that. Plus, you're not going to be able to do that anyways. Your broker won't allow you to if you're a beginner. You must have a very large portfolio size, like myself, to sell naked call options. It's called naked call option selling. Okay? Don't recommend it unless you're advanced, unless you've been coaching with me for over 6 months. So let's talk about now how this looks like. Okay? Again, you need 100 shares to sell a call option. If you own 100 shares, those shares rise in value, and you have a covered call or you've sold a call option, that's okay. Because if that call option goes up in value and that person wants to basically get shares, they want to exercise their right, the buyer of the call option, you're covered. You're covered. You have the shares to give to him, okay? If that stock goes up a lot, that's okay because you have the shares to give to that person. Whereas if you just had a naked call option, you don't have the shares. So if he wants to buy to exercise his rights, you're in big trouble. The other different thing about selling options is that you get paid upfront for selling the option.
That's right. Instead of having to spend money, you actually get paid, you get to collect income instead. If you remember, the premium that the buyer had to pay up front and how the premium goes up when the option is more likely to be favorable for the option, well, that's also true for the seller. As the premium gets higher, it's more attractive for the seller to actually get paid that premium. That premium is what you're getting paid up front for the risk that you're taking, because the risk is for a covered call or selling a call that you may lose shares of the stock. Now, the good news is your risk is actually losing the stock at that strike price. So, for example, if you buy a stock for 100 and sell a covered call for 110, well, you risk losing the stock at 110. But the thing is, that could be a good thing. What if you want to sell the stock for 110 anyways? That's why selling options can be very favorable, because you get paid to sell an option, and then you also get to pick the strike. So you have full control. You have so much control as an option seller. You know exactly the strike price that you want to sell at. Whereas the option buyer, you have some control, of course. You know what strike you're going to buy at, but you don't know where the stock is going to move. In the other scenario of selling options, if the stock doesn't really move anywhere, it just goes sideways, that's fine. If it goes down, well, that's not great, but if you were to own the stock anyways, well, now you're still losing the same amount of money, but you get an option premium. So you have collected income regardless. If the stock goes down, you have income. If the stock goes sideways, well, that's fine, you got paid income. If the stock goes up, you still get paid, but now you just have to give up your stock. So for example, if you pick a really far out of the money option and you pick a really far out of the money strike price, in this case of a call option, that means that the strike price will be way above the market price. So it will be very unlikely that the stock will shoot up that high. Meaning, it is actually not very valuable option for the option buyer. That means that the premium upfront that you will be getting is actually pretty low. However, it's also very safe and consistent. It's actually just some income in your pocket, and most likely you won't even lose your stock anyways. So in this scenario, you can collect some income every single week, every single month, or every couple of months by selling options and not even lose your stock. That's actually the way that I like to go about it. And we can see that if we look into my Robinhood app right now. I'm going to pull up some examples and show you how collecting income actually works and how much money you can actually make on a consistent basis. All right, so we're going to be looking at Palantir. This is another example. I do have some shares of Palantir right now. I have currently a little bit over 3,000 shares, which makes up about 4% of my portfolio value. So if I go and trade Palantir options, actually you can see here, this is actually a perfect example because I'm currently running a covered call strategy. You can see here how I have sold the $25 call options. So right here you'll see that I have sold $25 calls. They're currently worth $1.18. But let me just show you an example from scratch. So if I go to trade options, okay, and now I'm going to show you what selling a covered call looks like. So let's just pretend we have 100 shares of Palantir. So now if I wanted to, I can go out about a week. So let's go to a week out and I go to sell call this time. So instead of buying calls, now I am clicking sell call. So if I wanted to sell a call, let's say I wanted to sell with a strike price of 24.5, I'm going to sell here 24.5. Now you will notice that if I click continue and I go for one contract, I can actually make $132.97, or basically $133 by selling one call option at 24.5. That's for 1 week. So I can start making $130 per week just from 100 shares of Palantir, which wouldn't be too expensive. Buying 100 shares would be about $2,000 something. The further into the money that I go, the higher that I get paid. You can see right here that makes sense by going down 24, 23.5, 23. The premium is increasing. And also, if I did want to increase the expiration day, so let's say that I wanted to go out all the way to January 2025, you can see here how the premium is actually really, really big. So you can buy 100 shares of Palantir, and then you can sell a $25 call option. You would actually get paid here over $400, and you're only putting up about $2,000. So, you're getting 400, you're putting up 2,000. That is a percentage return that is over 20% for 1 year. If I choose a longer expiration day, like 2 years out, the premium is only going to go up. And, the stock is more likely to basically go up to that strike price. So you are more likely to make money when you do go farther out. That's not as exciting, but that is more consistent. If you want to sell options that expire way into the future, you will get paid as the option seller because, well, you're getting paid for the risk of potentially losing your stock. But again, losing it is not that bad because here it doesn't mean that we lose any money on the stock itself. we're still buying the stock for $24 per share, and then we're selling it for $25 per share, and we're getting paid to literally sell the stock for more money. So the only real risk here, and this is not really risk, it's more opportunity cost. If Palantir or whatever stock you're running this strategy on goes up a lot, well, you don't necessarily get to make all that money. You get a predetermined price. So here you get $25 plus the $4, which would be the $29 as your break even. That doesn't mean that you start losing money when it goes up. It just means that you can't make more money. The reason why you can't make more money is you will get assigned for sure. Someone will want to buy the shares from you. You will lose your stock. And when you do lose your stock, well, you basically lost it at 25, and then you got paid $4.35 for this trade. So you have a basically guaranteed exit if the stock goes up. Now, this is the fun part. Let's see what happens to me as a seller in different scenarios. I'm going to be using some real numbers here because I want you to understand exactly what will happen in different scenarios. So if it goes up to just 25 exactly, my profit would still be the difference, which is 25 and the 24.16. So I'll make $84, excuse me, plus the premium of $435. So while the stock investor only made, $5 or so, I've actually made the same $85 plus $400. So I have gone way better than just a regular stock investor. If the stock goes up to 26 or 27 or 28, I'm actually better off in all of these scenarios until 29.40, which is our break-even price. From there, I won't be better off than a stock investor, but I will still be pretty good off because I'm still going to be ending up with a good return. That means that you, as the option seller, basically are agreeing to sell the stock at a certain price. You're getting paid for that contract, and then you pick the expiration date. So you pick how long you want to wait. So if you want to go really short term in expiration, you can do weekly option trading and make $100 a week or so based on $2,000, which would be an insanely high return. It may not seem like it's so much money, but at the same time, if you're consistently making that amount and you scale your portfolio, you will get into the retirement zone. You'll be able to replace your income. And you'll be like many of my students who, I have a student named Denny. He was in my program years ago, but I like to bring him up because he was a one-trick pony. He had one option strategy. He had $300,000, and he was making $6,000 to $10,000 per month consistently every single month for basically 12 months per year. Now, he does have some hiccups here and there, and that's because basically the market does go up and down, and sometimes we don't have winning months. If I told you every single month was a winner, I'd be a complete liar. But in the example of Denny, he's doing really good consistent income just based off one strategy. So this option trading stuff, you may think it's hard, but it's really not. As long as you master this stuff, which doesn't take that much time, you just need to master the fundamentals, the basics, basically the simple math. You don't have to have any high level of mathematical ability. You just have to sell, for example, a covered call. You can make $5,000 to $10,000 per month. Now, for this example, and for basically collecting premium, what you want to consider is that collecting more premium is better in most scenarios. However, you don't want to go for in-the-money options because here with the covered call, it's a little bit different. When you go for an in-the-money option, you truly are cutting away some of your opportunity to make more money. Because in this scenario, if I go to, let's say, 23, my break even here is 25, which is okay, but it's not really giving us that much upside. You always want to go for a slightly out of the money option. So what I would do is I would go for 24 and a half. I would go for 25. I would go for 26. I would give yourself some room for upside because not only do you get the premium, but you also get some upside for the stock itself. Now, in a scenario that the stock goes down, again, you will lose money. But that is just the basic laws of how the market works. If the market goes down, you will lose money, regardless of what market you're trading. Not even option trading, in any market, even if it's used cars, you will lose money when the stock market goes down. And that is just something that you have to deal with. And the way I get through this is I'm always dollar cost averaging, which means that I'm always buying more when the market goes down, or I'm simply being patient and waiting for the market to recover. I do have a story where I actually got my father into investing, and I have been telling him that he needs to dollar cost average. And he didn't really listen to my advice. He said, I'm going to wait and see if it recovers. But the thing is, with dollar cost averaging, if you buy a stock at 100 and it goes to 90, it is really, really smart to buy more at 90 because that way you are reducing your cost from 100 to 95. Well, if you buy one share for 100, and you buy a second share for 90, your average price is now 95. So all you need to happen is the stock needs to go back up to 95 for you to have a break even. But if you don't dollar cost average and your average price is 100 and just goes down to 90, now it goes back up to 96, in the first scenario of dollar cost averaging, you would actually make $1. The second scenario of not dollar cost averaging, well, you didn't make your money back. However, it's totally okay not to dollar cost average if you just don't have the money. It is okay because the market does go up on a long-term basis. And option trading, the way I do it and the way I teach it to my students, is that I want to go for safe, passive, consistent income. And even in the worst case scenario, I just have a simple matter of time to break even. So if the market is down, actually options are really good because they're hedging your portfolio. So when you're doing a covered call strategy, you're actually more hedged than the average stock investor. So when the market goes down, you're actually losing less money than the market. So it's actually very beneficial. The way that I trade options is actually safer than stock investing. It's safer than really any form of crypto or futures or any other investment vehicle. I prefer options because not only can I make good high income, I can also do it at a relatively low risk. Now, this isn't as low risk as just putting your money in the bank and just getting a 1 or 2% return, but also who cares about 1 or 2%? We're after 20, 30, 50% per year. I've had years in my trading account where I have 7x my money, where I've taken $100,000 into $700,000. I did take a lot more risk. I was a lot younger, but that is very, very possible to scale a small portfolio very quickly. So look, as a buyer, if you're buying options, you just need enough cash in the case to basically buy that option. So if I were to be an option buyer and I go to buy right now, you see nothing really changes. I mean, just a little bit. It goes from $1 on the 25.5 call to basically $1.04. That's just the basic bid-ask spread price. So if you look right here, I clicked in here, you will see that there is going to be a bid at $1 and an ask at 104. And that's what I mentioned in the beginning of this trading video, is that if you're going to be buying, you're going to have to be buying closer to 104. And if you're going to be selling, you're going to be selling closer to 1, which is the bid price. Now, you might be thinking, as a seller, if I have the chance to be forced to sell 100 shares of a certain stock, in the case of the covered call option that we are talking about, or selling call options, then what happens if I don't own 100 shares of stock, which would be really expensive, in the case that a company goes up a lot, like Apple? Do I need to have 100 shares? The answer is yes. In covered calls, you need to have 100 shares. In selling calls, you need 100 shares. In buying options, you never need the shares. You can buy options all day, whether it's a call or a put, as we will talk about shortly. So it does depend on the type of strategy that you're using. But in almost all cases, you don't need 100 shares unless it's a covered call option. The other scenario would be selling a put, which we'll talk about later, but you still don't need the shares. So you can basically get the idea of needing shares out of your mind and just treat options as a standalone vehicle aside from the covered call strategy. So, what we're talking about, the covered call strategy, is you do have to own 100 shares of stock, and that's because you are covered. That's why it's called a covered call, because in the worst case scenario, you are covered to not losing money. If you don't have the money to buy 100 shares of stock, you can also borrow money from your brokerage that you're trading on. This is called selling a call on margin. And yes, you can also buy options on margin as well. It can be very, very risky to trade in margin because you're using money that is not yours. That means if you lose a lot of money on a trade, you're going to be in a really, really bad spot. For this reason, I don't recommend that you use margin unless you have a very high level of trading ability and you also have a bigger portfolio. I do work with many clients that have a bigger portfolio, and we do lots of margin trading in a safe way without even paying any interest. That is in my Discord program. Again, feel free to join that in the first link in the description if you want to learn more. Now, I want to mention a few more things that you really need to understand. On some platforms, you can sell naked calls, which means you can sell a call without actually owning 100 shares of stock. This is very rare because Robinhood won't let you do that, and many other brokerages also won't let you do that based on your account size as well as your level of trading ability. So if you have a level 1 option account, level 2 trading account, you won't be able to do this. You need the highest level of permission in your brokerage account. Now, I'm not an expert on third-party brokerages, but you can always call your broker and ask them how to get that. I personally prefer to focus on much safer, really consistent option trading strategies myself because I want to go after consistent income. I really want to rely on option trading to fund my lifestyle. I am traveling a lot and I'm renting and really living a life based on my option portfolio. So it's really important for me that I have a consistent source of income. For me, I'm making over $80,000 per month trading options. However, in the beginning, my goal was just to make $2,000 or $3,000 so I could pay for my rent.
And that brings me to a really good income right now, but it wasn't always like that. It has to start somewhere. So hopefully I'm part of your journey of starting option trading and really opening up your mind to the potential to making a lot of money with this one day. Even if you start off with making $100 a week, that's a fantastic place to start. Never feel shy or embarrassed about your starting point because we all have to start somewhere. So I'll show you more of that process later on in this course. So hopefully now you're starting to understand how both sides of a call option works, whether it's buying and getting that unlimited upside or selling a call option, which means that you do have to own 100 shares of stock, and you're still in both scenarios picking a strike price, where as a call option buyer, you're picking a strike price to, purchase, and hopefully that stock goes up. As the call option seller, you have a strike price that you kind of hope does not hit. You hope the stock goes up towards that strike price, but you hope it doesn't really go too much past it, because if it goes past it, then you have to lose your shares. If it goes towards it, you're making money on the stock and you make money on the premium. That is the perfect case scenario. So again, let's say that you have a stock at 100 and then you sell a covered call at 110. You want that stock to go up to $109.99. If it ends there, you're going to be a very happy camper because your stock went up by $9.99, but it didn't hit the strike price. So that call option buyer, he lost everything. As a call option seller, you've already been paid when you sold that option, so you're in the perfect case scenario. And the seller receives a premium up front, but has to sell 100 shares of stock at the strike price if the buyer chooses to exercise it, which they will if the stock goes up into that strike. And this all has to happen within the expiration date. If the option expires without the buyer exercising it, the seller gets to keep the premium and their 100 shares. Cool. So now that you know call options, let's talk about put options. How do put options work? Well, a put option is essentially the opposite of a call option. There's still two sides. There's a put buyer, there's a put seller. There's always going to be a buyer and seller in all option trading scenarios. The buyer is buying an option to sell the stock at the strike price that they choose. So, unlike call options, a put option bets on a stock going down. So when you buy a put option, you want the stock to fall. This is why options are so awesome, because as a stock investor, basically you only make money when the stock goes up. Okay? With options, when you buy a put, you want the stock to fall. As it falls, you actually end up making money. So remember, with the call option, the buyer is buying the option to buy 100 shares of the strike at the strike price. And with a put option, the buyer is buying the option to sell 100 shares at the strike price. Since the seller of the put option is selling that option to the buyer, if the buyer decides to exercise their option to sell their 100 shares, that's fine. That is how it works. So the buyer of a call wants it to go up, the buyer of a put wants it to go down, and they want to sell their stock. So in one scenario, they want to buy the stock. In the other scenario, they want to sell the stock. So the seller of the option must buy the stock from the seller. Just reversed. So just think about it like this. When you buy a put option, it goes down, you make money. When you sell a put option, when it goes down, you do get income, but now you have to buy it from the buyer. Now, as you may have guessed, the price of the put options premium works the exact same way as it does with call options. The more favorable it is for the buyer, the more expensive the premium is going to be. The less favorable it is for the buyer, aka more risky, the cheaper the premium will be. So let's go through some examples right now. A put option gives the holder the right but not the obligation to sell Starbucks at the price that you choose, the strike price, within a specified period of time. This means that if the price of the underlying asset decreases below the strike price, the holder can still sell at the higher strike price, thereby profiting from the decline in the asset's value. I'm going to give you an example right now. So Starbucks stock price, $73, and you buy a long put option with a strike price of $70. Okay, you pay a premium for the put option. Let's just say you pay $1, hypothetical example. As Starbucks falls to $65 per share, here's what it's going to look like. With the stock price dropping below the put option strike price of $70, the put option becomes in the money. So for a put option, it's in the money when the stock drops below the strike. For a call option, it's in the money when it goes above the strike. So for a put option, you want it to go down. When it goes down, you are making money. So this means that the holder of a put option now has the right to sell Starbucks shares at the higher strike price of $70. So if Starbucks comes crashing down, you're perfectly fine with that because you get to sell it at $70 no matter what, because you own that put option. Even though the market price declines and it goes down to 65, that's perfectly okay. So the put option holder can buy shares at the market price of 65, and then he can sell at a higher price of 70.
realizing a profit of $5. Since each option contract typically, in all cases represents 100 shares, the total profit would actually be 500, the $5 times 100 shares. So deducting the premium paid for the option, which we said was $1 or $100, that means we have $500 of profit minus the $100 that we paid, which gives us $400 of profit. That's the first example. In the first scenario, I have two more for you about how a put option works if you're buying them. By the way, before I get into the second and the third example, I want to say this is a really good time for you to subscribe. I would really appreciate it. Plus, it will really help you out because I have a lot of videos that are coming out on a frequent basis teaching you how to make money option trading. That's all I really ask. Let's do another example, another scenario. The long put option in the prior example that we just did was, basically making us $400. But in this example, what I want to go over is going to be a different stock. So let's take Apple, okay? Let's say that Apple right now is around $175, and then we're going to buy a long put option with a strike of 170, okay? So we're at 175, and we're going to buy a 170 strike, okay? We think that the stock is going to fall down, and we're going to pay $2 for this, okay? A little bit higher premium here, and let's just say that the stock does fall down, but it only falls down to 171, okay? So here's how the scenario unfolds. Since the stock price is above the strike price, the put option remains out of the money. The holder of the put option doesn't exercise the right to sell the stock at the strike price because, well, it's not profitable to do so. In this scenario, the put option expires completely worthless. As this holder wouldn't really exercise it, there would be no point. There's nothing to exercise. There is no intrinsic value. And there's actually no extrinsic value either when the option expires and there's no more time left. So it is a complete loss when the market price is above the strike price in the case of buying put options. The loss would be the premium paid for the put option, but good news is you can't lose more than what you pay when you're buying options. Therefore, in this case, the net loss per contract would just be the $200 that you paid, the $2 times 100 shares for each contract. So $200 would be your loss. Apple's stock price fell from 175 to 170. However, it did not reach our strike price of 170. So this is an example of a put option that you can buy where, whether you want to hedge your portfolio, whether you just want to make money on the put itself, right? That's fine. There's two different ways you can make money when buying puts. You can make money by the put option going down, or you can save money when the stock goes down. You actually hold the shares. You're able to get out of the shares with your put option. You're able to actually exercise a long put option and get rid of your shares. But in most cases, you will probably be just buying a put option. So if you're just buying a put option, you would experience a full loss. Now, I want to go over another scenario number 3. We'll just pick any other stock, maybe Chipotle, $3,000, okay? You buy a long put option strike price, okay? And you buy a put option for $2,900. So the stock is at $3,000. You buy a $2,900 put, and you pay $100 for the rights, basically, of buying this put option, okay? Now, let's say that the stock does fall below your strike price. It falls from to $2,850. Okay, so the stock was at $3,000. You bought a $2,900 put, and now the stock falls down to $2,850. So you're in the money by $50. But here's how the scenario unfolds: with the stock price falling down to $2,850, in actuality, you are in the money by $50. However, because you have paid $100 in premium to get into the option, right?
Hey, Mike. Good news. A house just popped up on the MLS. Do you have time for a quick video tour?
We're a little tied up right now.
No worries. I'll send you a video walkthrough and we can go through it when you're free up. We can talk through timeline and next steps as well.
Okay, thanks. That'll be fantastic.
Oh,
Are you sure you believe in the
this place has the kind of space you've been looking for.
Yeah, space. Space will be good.
Expertise is one of the many ways an agent who's a realtor works for you.
My ankle here is fucking killing me. I don't know what the fuck is going on. This shit is hurting me. I just sprayed it. And it's like the nerves. For some reason the nerves in there just like